Following my recent video arguing that the US is heading for very high and possibly even hyperinflation, it's time to talk about why and how money needs to be replaced by a digital voucher system. It's May 2025, which also means it's 150 years this week since Marx wrote the Critique of the VOUCHER program, where he talks about labour certificates. My video editing skills aren't really good enough to make an illustrative video for this one, so I've updated an essay I wrote in 2020, and I'm just going to go over this area with this sort of read-along style video for now. So the article is called "Fiat Currency is Dying a Natural Death. Its Logical Replacement is a Digital Voucher System Pegged to Labour Time." British pound sterling has lost more than 99.5% of its purchasing power since 1750, the start of the Industrial Revolution. The US dollar, the global reserve currency, or the main global reserve currency, has lost 97% since the start of World War I in 1914, or 95% since the end of World War II, when the US supplanted Britain as the world's imperialist superpower. That means today's dollar was worth only 3 cents in 1913. A dozen eggs in 1913 cost 13 cents, but now costs $6.20. A typical US home worth $6,300 in 1913 now costs $420,000. Since the inflection point of 1968, around the time when capitalism started sinking into its first serious post-war global contraction, the dollar's devaluation is still as high as 90%. The average inflation rate of the US dollar since 1968 has been 3.97%, up from 3.17% since 1914 or 2.14% since 1850. Inflation and devaluation are evidently accelerating. Inflation and devaluation are two sides of the same greenback. Right-wing libertarians claim the crisis stems from the creation of the central bank in 1913 and the cancellation of the gold standard, which amounted to the privatization of gold. That theory does not explain banking and economic crises that preceded the end of the gold standard or 1913, the first national US banking crisis struck in 1907 after all, which inspired the creation of the central bank. The gold standard became a fetter on productive expansion and capital accumulation by limiting the number of dollars that could be printed and therefore invested. The main driving force behind the process and its accelerating tendency is in fact capitalism, or capital accumulation per se, self-expanding value through the expansion, innovation, and acceleration of commodity production. Make the same number of commodities in less time than before, and all else being equal, their exchange or monetary value falls. Money, the universal equivalent commodity that enables or mediates the exchange of commodities of differing value, is therefore also devalued by productivity gains that capitalism depends on, since devaluation manifests in economic contraction and therefore has to be offset by making and selling more commodities in less time. As the number of commodities in circulation rises, along with the number of transactions, so too does the money supply. What I'm saying there is it's an inherent tendency of the capitalist system, not simply a policy choice made by a group of individuals at the central bank. The automation revolution is exacerbating the process not only because it speeds up production time and capacity, but because it is abolishing the source of monetary exchange, value, and profit, which is the commodification of labour time. The less time needed to produce a commodity, the less labour time, exchange value, or profit it contains. With the global economy increasingly dependent on automated production and commodified data, with hardly any labour time per unit of data required, especially with instantly replicated data, the amount of exchange value contained in each commodity is approaching zero. Other factors, of course, are contributing to the decline of the pound and the dollar, mainly capitalist competition, although that is inherent to capitalism as well, and tends to intensify as profit rates dwindle and fewer capitalists, at least relative to total capital, are left to fight it out over what profitable opportunities remain. With US capitalism increasingly faltering due to its highly automated productive system, the US is increasingly dependent on parasitic practices that drain value out and away from the rest of the world. Anyone resisting risks being subjected to US sanctions and ever tightening US sanctions, denying them the use of the dollar, and again forcing them to look for alternatives to the dollar. Sanctions on Russia after its 2022 invasion of Ukraine reinforced the trend, and Trump is upping the ante by implementing high tariffs, which are import taxes, with the aim of forcing trading partners to lower their tariffs on US imports. That's one of the aims anyway. Trump's administration does want a recession to devalue capital and partially devalue the dollar to make the latter more competitive, but of course not to the extent that the US dollar loses its dominant status in the present conditions, an extremely tricky balancing act. Since the end of World War II, the US dollar has been the world's dominant reserve currency, and most global trade is conducted using the US dollar. Rising demand for the US dollar appreciates its value, but also makes it increasingly expensive to acquire, incentivizing moves to trade without the dollar, find bonds to buy that are cheaper than US Treasuries, that is, debt, and stock up on hard assets, especially gold. China, previously the highest buyer of US debt, has been diversifying its foreign reserves and has reduced its holdings in US bonds from $1.3 trillion in late 2013 to below $760 billion in January 2025. Russia and even Saudi Arabia, India and Turkey have also been diversifying. In the first quarter of 2020, the dollar's share of trade between Russia and China fell below 50% for the first time on record, down from 90% in 2015. In 2023, the figure reached 39%. Even JP Morgan, the US's biggest commercial bank, told its clients in August 2019 to sell the dollar. In 2024, the bank said some signs of de-dollarization are evident in the commodities space, where energy transactions are increasingly priced in non-US dollar currencies. For example, Russian oil products exported eastward and southward are being sold in the local currencies of buyers or in currencies of countries that Russia perceives as friendly. Elsewhere, India, China and Turkey are all either using or seeking alternatives to the greenback. In addition, central banks, especially those in emerging markets, are increasing their gold holdings in a bid to diversify from the US dollar-centric financial system. Central banks collectively bought a net 1,136 tons of gold in 2022, the highest annual demand on record, and another 1,037 tons in 2023. This reduces their need for precautionary reserves of US dollars and US treasuries, which in turn frees up capital to be deployed in growth-boosting domestic projects. The purpose of this article, however, is not to speculate on the possibility of a new currency emerging to displace the US dollar as the main global reserve currency. A new one would not last as long as the dollar has. Chinese renminbi has also lost 79% of its value since 1987, when China had started to privatize large swathes of its then more or less fully socialist economy in order to ease tightening US sanctions that strangled its development. The crisis of US capitalism, which deepened, as mentioned, in 1968 or around that time, increasingly compelled it to privatize any form of public property, compelling it to intensify its attacks on the socialist bloc, something that reformists never grasped. Here we've got a chart of the US and Chinese money supply, and you can see that China's, despite having a larger public sector or publicly owned portion of the economy than the US, which basically doesn't have hardly any publicly owned property left. China's money supply has surpassed the US's, obviously because it's a country with a much larger population and has become the world's industrial powerhouse. If productivity growth and innovation are to continue, as has been the tendency throughout human history, then we must move beyond money and therefore capitalism. Overcoming each recession compels capital to seek mergers and acquisitions. The volume of deals greater than $1 billion in value increased by 17% in 2024, and their average value rose. Around half of US banks and publicly listed companies have disappeared since the turn of the century, and the average lifespan of S&P 500 companies, the richest in the US, fell from around 60 in the 1960s to below 20 in the 2010s. US capitalism is evidently in a death spiral, and a final merger is becoming an economic necessity for the first time, entailing public ownership of the economy, since no exchange of ownership and no money, therefore, is necessary in a total monopoly. Amid falling creation of real new value in commodity production, capital is becoming increasingly dependent on the state to sustain the ever greater steepening demands of accumulation. See rising fossil fuel subsidies, for example, as highlighted in this graph. State monopoly capitalism is therefore evolving towards and demanding a revolutionary transition into state monopoly socialism. As of the 29th of February 2020, the US Central Bank, the Federal Reserve, held $2.47 trillion, 14.6% of $16.9 trillion marketable US Treasury securities outstanding, making it by far the largest single holder of US Treasuries in the world. By the end of March, this increased by an unprecedented monthly $650 billion to $3.12 trillion. One estimate said that if this pace of buying continued, the Fed would own the entire Treasury market in about 22 months. As of the 23rd of November that year, 21% of all US dollars have been printed in 2020, taking the figure to 75% in just 12 years, already sparking fears about possible hyperinflation. Indeed, the highest bout of inflation in 40 years followed. A basket of groceries that cost $100 in November 2020, now in 2025, costs $126. Here we see the M1 money supply spiking dramatically in 2020, M1 being the most liquid form of money in the economy. Anyone who believed that the explosion in the money supply was a temporary consequence of the COVID-19 pandemic was sorely mistaken. Like now, as was the case in 2019, the US has reached the point whereby accumulation amid rising unprofitable surplus capital needs a recession in order to devalue capital and cheapen investment. This is best illustrated by US money market funds, money capital sitting idle waiting for profitable opportunities in production to turn up. Note the steepening trends and peaks before and around the 2001, 2008 and 2020 recessions and now. And we can have a quick look at that and see how low it was in 1980 before rising to around 230 billion during the 1982 recession. It then fell through that process of devaluation via the recession before climbing again to a new peak of 555 billion in 1990. It then barely falls at all and then climbs after 1995, and we really see it starting to steepen quite drastically up to $2 trillion in 2001 when the dot-com bubble was bursting. It then declined through that process of devaluation but climbed back up again to a new record, again resulting in a peak in surplus capital during the recession of 2008, peaking at 3.8 trillion before again declining, flatlining for a while, and then again suddenly in 2017 it starts climbing again up to a new peak of 5 billion in 2020 when we had the pandemic and the lockdowns, but were of course on course for a recession. But that recession, as I'll come to, barely interrupted the rise of surplus capital, and today it has risen in the US money market funds, which is a prime example of surplus capital that cannot be profitably invested, and it's risen to $7.2 trillion. While the money supply and the Federal Reserve's balance sheet both started to decline after 2022, both are now rising to new highs again, signalling a new round of accumulation and devaluation, which will result in a concentration of capital as private enterprise that goes bankrupt is bought up on the cheap by those sitting on larger money reserves. Here we can see the balance sheet of the Federal Reserve declining after 2022 for a while, but now climbing back above that April 2022 peak. And the same goes for the broader money supply, the M2 money supply. It dipped at the fastest rate since the Great Depression after 2022, but is now rising again and is basically back on trend from before the 2022 recession. Another explosion in the money supply is not only going to devalue money, but rising bankruptcies will curtail supply and create added inflationary pressures, at least until demand falls as a result of job losses and falling incomes, although capital investment demand from the remaining capitalists will rise for a while before cuts to production are made to raise prices. Other reasons point to the US being on course for hyperinflation. In 2008 and 2020, investors fled the stock market to US 10-year treasuries, pushing up the price of those treasuries and boosting the US state's revenues, upon which capital is increasingly dependent, bringing down the cost of long-term borrowing, including for the US state. In 2025, however, the spiraling US debt, exploding from $23 trillion in 2020 to $36 trillion in 2025, has seen the cost of paying interest on debt after paying the debt itself soar to 14% of the US state's budget, up from 6% in 2010. The US state's first trillion in debt took over 200 years to accumulate in 1980, but that amount is now added every 4 months. It is the state's fastest growing area of spending, and only Social Security now takes up a bigger share. Defense in that time has fallen from 20% to 13%, despite its enormous absolute growth. As revenue intake falls, state spending rises, as the state has to issue more debt to make up the shortfall. And any corporate tax cuts that Trump introduces is going to exacerbate that problem. Lending to the US state, especially in a crisis, is therefore looking less and less attractive, as confidence in the state's ability to repay the debt, and with interest, is falling, exacerbated by the added uncertainty generated by the Trump administration. Stock market investors are instead more likely to flee to gold and Bitcoin, or to debt from other countries. The price of Treasury bonds has crashed by 50% since 2020. The interest rate on the 10-year Treasury, closely linked to long-term borrowing and mortgage rates, is therefore tending to rise, both because the risk of lending has risen and to make it more attractive to buy. Trump's administration likely expected the 10-year yield to fall after his tariff hikes, and in the first 24 hours, it did by 0.1%. It then rose, however, from 3.99% on the 4th of April and 3.6% in September 2024 to 4.3% at the start of May. The government is having to take out new, bigger loans at higher rates to pay off old debt. The average interest rate on repaid government debt was 1.772% in 2020, but has now risen to 3.284% because, of course, different bonds mature at different times. Rates will tend to go higher, and the tax base will collapse. This trend is to be expected. When surplus capital reaches a point at which economic GDP growth flatlines, the central bank lowers its overnight lending rate, incentivizing banks to search for higher rates on the market. Doing so staves off or shortens a recession, but also induces it by catalyzing borrowing, lending, and investment, the process of devaluation and capital concentration. The Federal Reserve's rate landed at 0% for the first time ever in 2008 and stayed there until 2016, before steadily rising to 2.4% in June 2019 and then falling back to 0% at the start of 2020. On average, since World War II, ending a recession requires a 6% rate cut. The short-term rate cut in 2020 barely interrupted the rise of surplus capital. Banks hit out at the prospect of negative interest rates during that period of 0% rates, even declaring them to be the path to Soviet-style banking, saying it would slash their earnings and limit their ability to absorb loan losses. Bank of America analysts estimated that a Bank of England rate cut to just minus 0.25% would depress the banking sector's average return on equity into low to mid single digits and take 50% off Barclays' domestic pre-tax profit, rising to more than 70% for RBS and Virgin Money. Central banks are stuck between a rock and a hard place. Rates could only really go back up, and with 40-year high inflation in 2022 as a result of investment demand rising amid broken supply chains after the pandemic and lockdowns, the Fed rose its interest rate in order to stabilize the currency, tackle inflation, and give banks somewhere to accrue interest they couldn't find on the market. The 50-year trend of falling interest rates is likely over, barring a plunge into negative rates amid hyperdeflation, which would follow hyperinflation unless we skip straight to hyperdeflation. Borrowing rates of 0% likely represent the historical limit of expanding commodity accumulation, at least in the US, UK, Japan, France, and Germany. Rates will therefore continue to tend to rise, and commodity production will tend to contract, with accumulation therefore increasingly dependent on centralization, as in the concentration of capital into fewer hands, bleeding smaller or failing competitors, and the public dry. The Fed's small rate cut in 2024 unusually pushed market rates up because inflation rose. As you can see from this graph, the Fed cuts after July 2024 resulted in inflation rising, as you can see from the red, green and yellow lines here. They have fallen a little bit since then, but that was enough to make the Fed nervous enough to hold rates where they were and cancel further planned cuts. And they still haven't cut since then, despite Trump's demands for a cut and despite the uncertainty caused by his tariff announcements. Fed rate cuts back towards zero, designed to end a recession and cheapen borrowing expected by any corporate tax cuts, which may have already started. US GDP shrank by 0.3% in the first quarter of 2025, and oil prices fell by 20%, likely leading to an increase in imported oil in the US as domestic producers cut production, would accelerate the devaluation of the dollar, appreciating import costs and inspiring even higher bond sales and interest rates, likely sparking very high, perhaps even hyperinflation. Germany, of course, is already in the midst of an 18-month recession. With the US dollar being by far the main global reserve currency, the threat of worldwide hyperinflation therefore looms. But far from being anyone's direct fault, Trump's or the Fed's, not that I'm a defender of either, this likelihood fits historically and logically with the devaluation of the currency over the past century, as capital accumulation has compounded absolutely. All fiat currencies will likely collapse against precious metals. As mentioned, central banks are buying gold as collateral in attempts to make their debt more appealing at unprecedented levels. The price of gold shot up to $2,500 per ounce in April, up from $1,500 in July 2023, $740 in September 2015, and $230 in May 2025. In US dollar terms, gold has gone up by 1,250% since 1999. The value of US Treasury bonds relative to gold has fallen by 70% since just 2020, showing that confidence in US debt is falling quite aggressively. The S&P 500, the benchmark stock market index, has also declined relative to gold in that time by 30%. The ratio of Bitcoin to gold, though, has risen by more than 500%. Although as a much younger hedging asset, Bitcoin's volatility is much higher, falling in value by 80% in 21-22, before rallying by 600%, that should say, since then, compared to gold's 15% dip and 100% rise. Gold's corrections and rallies in the past 13 years have typically remained within a 5% range, but when it was first privatized in the 70s, 30 to 50% declines were common. Since the tariff announcement, the S&P 500 fell by 12% and then rallied by 10 percentage points, but Bitcoin fell by only 8% and then rallied and recovered more quickly. This shows us that forms of surplus capital are again rising. Investors are looking to hoard stores of wealth, not productive investment, because that is increasingly unprofitable. Before moving on to the second part of this article that deals with the necessity of replacing capitalism with socialism and money with labour vouchers, I should just mention that the US has $7 trillion in debt repayments coming due later this year, and the government's only option is to borrow new money at the higher rates to pay back the maturing debt. As of the morning of the 9th of May, the rates on 10-year, 5-year and 2-year bonds have all ticked up again. So that means more borrowing at higher rates and worsening economic conditions and all the knock-on effects that we've talked about. Isn't capitalism great? Right, on to the socialist necessity. Historically, rates of interest, a parasitic form of profit, siphoned off from commodity production or created fictitiously through debt, have tended ever closer towards zero, as we can see here from this chart from the Bank of England. Again, because of rising productivity and accumulation. To keep them at zero for good, we need to abolish interest by recognizing that rising productivity historically demands the end of private capital, commodification, and profit. As McKinsey Global Institute Director James Manica said in June 2017, find a factory anywhere in the world built in the past 5 years, not many people work there. The automation revolution is making capitalism obsolete. Primarily, the source of value and profit, commodified labour power and labour time, is being abolished. Wage labour is becoming obsolete, meaning, as a secondary effect, increasingly few people will have the money to buy the commodities capitalists need to sell in order to realize the value created at the point of production as profit. To recap, the commodity is both a use value a thing with a specific utility and an exchange value. As more of the former are produced, the latter withers away, making a transition to a mode of production based solely on use value increasingly necessary. Socialism, a publicly owned economy whereby social accumulation usurps capital accumulation, enables production on a break-even basis rather than zero-sum profit, which is based on the theft of labour time, thereby abolishing inherent and inevitable recessions and mass unemployment. The required change in the mode of production then, in theory, is simple. Nationalise/socialise the means of production, then internationalise it. Replace for-profit commodity production with break-even utility production and peg the currency, in air quotes, peg the currency value to labour time. And so let's talk about what non-transferable labour credits are and how we might transition to implementing such a system. In a critique of the Gotha programme, Marx explains that under socialism, workers will be paid in vouchers or what he then called certificates, which they then use to draw down entitlements, quote, from the social stock of means of consumption as much as the same amount of labour cost, so use them to purchase consumer goods. The same amount of labour time, which he has given to society in one form, he receives back in another, end quote. Such vouchers, or what we might call labour credits, would be non-transferable, non-exchangeable, cancelled once spent, like train or cinema tickets, so you can only use them once. So in this day and age, you might use a credit card on your smartphone, and once you use the credit that is in your account, it's wiped off. It's as simple as that. So while socialism would incentivize and reward work, meaning absolute income equality, at least in its initial phase, is not feasible, it would also prevent most wealth from increasingly accumulating in the hands of a few, thereby keeping inequality to a strict minimum. Without class, economic exploitation will be abolished, labour power and time will be decommodified, so you won't be selling your labour power to a capitalist. Exchange value, in air quotes, still exists. The price of goods still equate to labour time, and more explicitly, in fact, which continues to diminish as automated production expands and improves, but it is qualitatively different, now based on use value instead of surplus value. Just to clarify, it is not actually exchange value anymore because exchange has been abolished. To re-emphasize, you draw down social entitlements that are socially produced and owned rather than purchase them from a private owner, which in capitalism deprives you of the human right to consume if you do not have enough money, which is increasingly the case for most people. Since labour is always together with nature a fundamental substance of wealth, labour time is an important measure of the cost of wealth's production, even if exchange value is eliminated, says Marx. With Britain's cash economy, for example, already close to collapse according to an Access to Cash review, we need to transition to a digital voucher/credit system. 6.5 hours of work, for example, will be rewarded with 6.5 digital labour credits. Chose 6.5 hours because obviously I'd like to see the shortening of the full-time working day, although that probably won't be possible until the counter-revolution has been defeated and the rebuilding of society is well underway. But alas, 6.5 digital labour credits will buy you, all else being equal, goods that collectively took 6.5 hours to produce. To touch on how the transition might work, money will still be used while the transition to public ownership of the whole economy is being made, and while imports are still brought in from capitalist nations, probably requiring the implementation of dual currencies, although digitalization might make trade with capitalist enterprises smoother than in the past, once power supplies have been fully restored, that is, since the onus could be put on them, converting digital voucher credits that socialist nations use in trade into money. Money in a socialist country can also be used as an accounting index without being used for exchange, so paper money could still be used while the digital infrastructure is being transformed, thereby enabling access to the currency for the whole population while digital infrastructure and training is being diffused nationwide and then globally. So obviously we want to make sure everyone can use vouchers, and so that's probably going to mean we're not going to skip straight to a fully digitized system because not everyone will have access. If if capitalist armies have destroyed infrastructure that is going to have to be rebuilt and all that sort of thing. Not nice to contemplate, but stuff that we have to think about. In Towards a New Socialism, Paul Cockshott and Alan Cottrell argue convincingly for such a system, but with an inbuilt grading structure to incentivize types of work such as night shifts and productivity rates. This system also makes budgeting far more intelligible, enabling a much more informed electorate who could vote on how much should be spent on each department of state spending. Cockshott and Cottrell argue for a flat rate tax, say 55% of every one labour credit earned, to fund state expenditure on healthcare, education, infrastructure, productive expansion, and so on. We might need to make tax rates more progressive to start with and work towards a flat rate. That's not something I've really thought about too much or looked into in too much depth as of yet. Consumer goods prices will be adjusted by a marketing algorithm according to supply and demand and shrinking labour content given the ongoing transition to full automation, which will include people gaining their own super powerful or increasingly powerful 3D printers, for example, which means communities and individuals will be less and less dependent on state enterprise as socialism develops. So this marketing algorithm based on supply and demand will ensure price stability. The price of a product rises against excess demand while the planners order its increased production and vice versa. Cockshott explains, suppose a radio requires 10 hours of labour. It will then be marked with a labour value of 10 hours, but if an excess demand emerges, the price will be raised so as to eliminate the excess demand. Suppose this price happens to be 12 labour tokens. The radio then has a price to labour value ratio of 1.2. Planners or their computers record this ratio for each consumer good. The ratio will vary from product to product, sometimes around 1.0, sometimes above if the product is in strong demand, and sometimes below if the product is relatively unpopular. The planners then follow this rule, increase the target output of goods with a ratio in excess of 1, and reduce it for those with a ratio less than 1. The point is that these ratios provide a measure of the effectiveness of social labour in meeting consumers' needs or wants across the different industries. If a product has a ratio of market clearing price to labour value above 1, this indicates that people are willing to spend more labour tokens on the item, i.e. work more hours to acquire it, than the labour time required to produce it. But this in turn indicates that the labour devoted to producing this product is of above average social effectiveness. Conversely, if the market clearing price falls below the labour value, that tells us that consumers do not value the product at its full value. Labour devoted to this good is of below average effectiveness. Parity, or a ratio of 1, is an equilibrium condition. In this case, consumers value the product in terms of their own labour time, at just what it costs society to produce it. This means that the objective of socialist retail markets should be to run at break-even level, making neither a profit nor a loss. The goods being sold off cheap compensate for those sold at a premium. A central marketing authority, probably initially selected by the party, but later, as the counter-revolution is defeated and living standards rise and living conditions settled back down, elected by the public, will regulate the standards of consumer goods, with enterprises motivated to make attractive products by the raised market prices. The progressive increase in free time for workers as production becomes more efficient will act as an incentive to both work and improve efficiency. In the long run, Marx anticipates free time becoming the measure of social wealth, with more and more free time increasingly unleashing human creativity and reviving independent craftsmanship. Sounds pretty damn good, doesn't it? Cockshott also talks about how this serves as a kind of revolutionary pedagogy. So even under capitalism, fixing currency to labour is one of the most important reforms socialists and workers should pursue. In his book Arguments for Socialism, Cockshott argues for such a reform in Venezuela, where the democratic socialist PSUV government, which seeks a path to socialism via bourgeois elections, has, having remained in government for 20 years, thanks mainly to strong support from the armed forces, but also a very organised working class, although I would suggest that the latter has been enabled somewhat by the former, has brought about a de facto situation of dual power, and around 70 to 80% of the Venezuelan economy does remain privately owned, and so it is still a capitalist economy, although many working class gains that socialists should critically support have been made. Cockshott argues that the PSUV government should fix the value of the bolivar to labour rather than the cost of living, for two reasons. Firstly, as labour productivity rises, a bolivar fixed in terms of labour hours will be able to buy more each year, cheapening the cost of living. Secondly, once the value of the bolivar has stabilized in terms of value of labor, then the labor value of bolivar notes should be printed on them in hours and minutes. This step would be an act of revolutionary pedagogy, since it would reveal clearly to the workers how they are cheated by their capitalist employer in terms of the theft of their labor time. Suppose a worker puts in a working week of 45 hours and gets back bolivars and sees that the hours printed on them only amount to 15 hours. Then she will become aware that she is being cheated out of 30 hours each week. This will act to raise the socialist consciousness of the people and create favourable public opinion for other socialist measures, such as taking more of the economy under public ownership. Pegging currency to labour time would then have something of a they live sunglasses effect. Cockshott then advocates for an accounting reform. All firms have currently to prepare money accounts. The government should make it a condition of their accounts being approved for auditing that they also produce labour time accounts and that they mark all products with their labour content. Initially, firms need not be legally obligated to sell their commodities at their true values. They could attempt to sell them for a price that is higher or lower than the true value, but since the consumer can now see when they are being overcharged, consumers will tend to avoid companies that sell goods at above their true value. This will put psychological and consumer pressure on companies that are overcharging. This too will be an act of socialist mass pedagogy raising consciousness. In the first few months before all goods have their labour values printed on their price tags, firms will have to impute labour values to the goods they purchase using the printed exchange rate between bolivars and labour hours. They will add the labour value of their inputs, the number of hours of work that are performed by their employees to get a labour value for the final product. The government should also move towards having a dual system of national accounts, labour accounts alongside money accounts, because at the level of national economic policy, there are many issues on which labour accounts would be more informative than money accounts. Money accounts hide the fact that what government economic policy really does is reallocate society's labour. Cogshaw also rightly says that recognition of Marxist labour theory of value should be incorporated into law. Click on that link to see Cockshot's study, which shows that higher labour intensity produces higher rates of profit, whereas higher capital intensity produces lower rates of profit, even if the absolute amount of profit is higher. Following such a law being passed, there would be a huge wave of activism as workers and unions seek to end the cheating that they and their ancestors have been subjected to. It would also bring about a very large increase in real wages, cementing support for the socialist government. The employing class, on the other hand, would see sharp falls in their unearned incomes. Employers who were active factory managers would, of course, still be legally entitled to be paid for the hours that they put in managing the firm, just like any other employee. In summary, pegging currency to labour should be near the top of the list of socialist and working class demands, but in historical terms, it is now also, for the first time, given the senility of capitalism and the advanced development of the productive forces, becoming an economic necessity, along with public ownership of the means of production. Just one note on the rate of tax or deductions from income. Marx assumed that even in the first phase of communism, which is once the transitional socialist state has taken all private production under public ownership, he assumed that most of the total social product will not be distributed to people according to the labour time they perform in the form of labour certificates, but deducted for the common use from the outset. And indeed, there's going to be a lot that the state needs to do in such circumstances. There will be expanded social services, education, health, utilities, pensions, etc., that are financed by deductions from the total product prior to its distribution to individuals. What the producer is deprived of, says Marx, in his capacity as a private individual, benefits him directly or indirectly in his capacity as a member of society. So instead of having lower taxes and then having to spend money on extortionate childcare, you will just get free childcare, which means you're not being subjective to rising rates of childcare in a private economy. You're just getting free childcare. So it's much more beneficial. Such social consumption will be, says Marx, considerably increased in comparison with present-day society, and it increases in proportion as the new society develops. As the working day shrinks, thanks to the development of technology and productivity, the scope of labour certificates will narrow over time until they become obsolete and we reach the so-called higher stage of communism. So both stages of communism, the lower stage and the higher stage, are where the whole economy is publicly owned, but there is a transitional phase from capitalism to socialism where a working class state is taking the economy under public ownership. Eventually, says Marx, in a higher phase of communist society, after the enslaving subordination of the individual to the division of labour, and therewith also the antithesis between mental and physical labour has vanished, after labour has become not only a means of life, but life's prime want, after the productive forces have also increased, with the all-around development of the individual, and all the springs of cooperative wealth flow more abundantly, only then can the narrow horizon of bourgeois rights be crossed in its entirety, and society inscribe on its banners, from each according to his ability, to each according to his needs. thanks for watching this video. If you've got this far, then well done for staying the course. And leave a comment below if you've got any questions or want to discuss anything. I will try to get back to you. Please donate if you can. You can sign up to my Patreon from $1 a month or make a donation on Ko-fi. You can make regular donations there as well. Obviously, only do that if you can. I know these are very trying times economically, and obviously I'm only really asking people with deeper pockets if they can do that. All my books are available, or my self-published books are available on my Linktree for free if you cannot afford to buy a physical copy, but please buy a physical one if you can, because again, that will help me out. These videos are very time consuming to make, and you know all this, so I won't bang on about it. But yeah, thanks again. And obviously there's a lot more detail that I could go into, but there's only so much time, and you only have so much time as well. And obviously there's more detail in the books. And of course, if you can like the video, that helps boost the algorithm, and obviously subscribe as well so that you can be alerted when the next video is out.